Welcome to the Bullion Signal Podcast. Today, we're diving into a fascinating and frankly pretty startling hypothetical case study. So I want you to imagine something. It's Christmas Eve 2025. The silver market has just hit a record high price. But behind the scenes, something is deeply wrong. The entire system is about to shatter. We're going to break down what happens when the paper promises of Wall Street run headfirst into cold, hard, physical reality. The source material we're looking at today starts with this incredibly powerful line. You know, when you see a record price on a screen, your first thought is probably celebration, right? A bull market. But this quote completely flips that idea on its head. It says, what you're seeing isn't a party, it's a funeral. A memorial service for the paper silver market that has been setting prices for the better part of 50 years. What a way to frame this story. So here are the facts of the scenario, laid out bare. It's Christmas Eve. The price is at a record $72 an ounce. But the COMEX, the exchange that is the heart of the global silver trade, is in total lockdown. It's frozen. Why? Because the vaults have been drained. There's nothing left. And that just raises the massive question, how on earth did things get to this? All right, so to understand how a machine like this breaks, we've got to pop the hood and see how it was supposed to work in the first place. You see, the COMEX silver market isn't really about physical bars of metal being moved around day to day. It's a massive, complex financial system that is built almost entirely on paper contracts, on promises. And that one detail is the key to this whole story. And that brings us to the central paradox of this whole system, and it's almost hard to believe when you say it out loud. Billions, with a B, billions of ounces of silver are traded on paper every single month. But the actual physical metal, the stuff you can hold in your hand, sitting in the COMEX vaults, well, it's just a tiny fraction of that amount. The whole thing is really a high wire act, and it's balanced on one single critical assumption, that almost nobody will ever ask for the real metal.
Now, here's where it gets really interesting, and this is a critical detail. Not all the silver in the COMEX vaults is actually the same. It's split into two categories. You've got registered silver, that's the pile of metal that COMEX can actually use to pay out on its contracts. Then there's eligible silver. Now, eligible silver is just metal that's being stored in the same building by private owners. It's off limits. It's not part of the game. Understanding this difference is what unlocks this entire crisis.
And this chart just shows you the scale of the problem perfectly. In this scenario, of all the silver sitting in those vaults, almost 3/4 of it is eligible. It's off limits. It can't be touched. Less than a third is actually available for delivery. It creates this dangerous illusion of abundance, this idea that there's plenty of metal, when the reality is something else entirely. So you have this incredibly fragile system. How did it finally snap? Well, it didn't happen overnight. The source material points to a frantic 4-day period in early December. This is when that core assumption, that nobody really wants the physical metal, was proven to be catastrophically wrong. This was the bank run.
This timeline really tells the story of the collapse. The month starts off looking okay, with about 150 million ounces of registered silver. But then, the requests for delivery start pouring in, an absolute tidal wave of demand. In just 4 trading days, nearly 60% of the available silver is just gone. The official response? Well, they just declare extra holidays, essentially yanking the emergency brake to stop the bleeding and freeze the system. And here's the knockout punch. The bleeding hasn't stopped. Even with the market frozen, there is still delivery notices stacked up for over 63 million more ounces, all due on December 30th. To put that in perspective, fulfilling that single day's demand would wipe out half of what little registered silver is even left. It's not a crisis anymore at this point. It is a mathematical impossibility.
Now, it's really easy to look at this and just dismiss it as another temporary market panic. But the source material makes a powerful argument that this time is fundamentally different. This isn't just a short-term scare. It's the inevitable endgame of a long-term, very real and accelerating scarcity problem. And this comparison here really puts it all into perspective. You know, a lot of people remember the Hunt brothers back in 1980. They were two billionaires who tried to corner the silver market. But that was an artificial scarcity created by leverage, and the regulators were able to end it with a simple rule change. But in this 2025 scenario, the scarcity is real. It's being driven by massive global industries and entire countries, all demanding physical silver at the same time. You can't just write a new rule to fix a real-world shortage of a physical thing. And the data really backs this idea up. For years now, the world has been in what's called a structural silver deficit. It's a technical term, but it means something incredibly simple. Every year we use more silver than we mine out of the ground. And for years, we've been filling that gap by draining the world's above-ground stockpiles, almost like a global savings account. Now, just let this number sink in for a moment. A cumulative deficit of 1.2 billion ounces. To put that in perspective, that is more than an entire year's worth of global mining production that has essentially just vanished from the world's stockpiles. And those stockpiles, well, they aren't infinite. Eventually, that well was always going to run dry. So where is all this demand coming from? Well, just look around you. It's coming from solar panels, electric vehicles, AI data centers, 5G networks. All the foundational technologies of our modern world are incredibly silver intensive. And then you add on top of that what the source calls sovereign demand, governments stockpiling silver as a strategic asset, nations hedging against geopolitical risk. It's the very definition of a perfect storm. Okay, so the system is frozen, the vaults are basically empty, and the entire world is screaming for real physical metal. What happens when the markets are forced to reopen after the holiday? Well, the source material lays out three potential paths forward. The first, and maybe the most likely scenario, is something called force majeure. It's basically an act of God clause. The exchange just comes out and says we can't deliver the metal, defaults on its contracts, and pays everyone off in cash. In that single moment, the paper price on the screen becomes completely meaningless, totally disconnected from the real-world price of a physical bar of silver. Scenario 2 is just kicking the can down the road, begging traders to delay their delivery requests. That just buys a little time. And Scenario 3 is the long shot, a black swan event, some totally unforeseen miracle like a massive new mine discovery that saves the day. Something the source finds highly, highly unlikely. But ultimately, the conclusion from the source material is that this event isn't just a market crash, it's a fundamental paradigm shift. It marks the death of an entire era where paper promises set the price of a real-world asset, and the birth of a new standard where the price is set by one thing and one thing only: how much physical metal you can actually get your hands on. So what's the real lesson here? What's the big takeaway? This whole scenario is a case study of what happens when the abstract world of finance slams into the brick wall of physical reality. When a system built on the promise of an asset is suddenly asked to deliver that asset on a massive scale, and it simply can't, well, that system breaks, period. And that really leaves us with a final, thought-provoking question to chew on. This might be a hypothetical doomsday scenario for one specific market. But what does it tell us about the true underlying value of tangible physical assets in an increasingly digital world that's built on layers and layers of digital promises? That's something worth thinking about. Thank you for tuning in to the Bullion Signal Podcast. If you found this analysis valuable, be sure to like, share, and subscribe so you don't miss our next deep dive. And as always, a quick reminder, This content is for informational and educational purposes only. It is not financial or investment advice. You should always do your own research and take responsibility for your own decisions.